Hello everyone. Today in this video we are going to learn about profit center accounting in SAP S/4HANA controlling. So in this video we are going to cover about define profit center organizational units, explain profit center master data structure, define the features of document splitting, introduce the concept of new general ledger segment reporting, define profit center update process, outline integration with financial accounting, materials management, cost object controlling, sales and distribution, describe the period and allocation in profit centers. We are going to cover all these topics in this video, and I am going to complete entire profit center accounting in this video because this is a little bit smallest uh, concept in the controlling. In this video, we will outline the use of profit centers. We will define the process of creating profit centers as well as their integration with other business processes. We will also outline the similarity and differences between profit center accounting and FI. We will finish our discussion of controlling with period end closing for profit centers. As a CO consultant, several common questions will arise when explaining profit centers. One of your first tasks will be to convey the concept of statistical value tracking versus actual values. Profit center posting are always initiated in conjunction with other objects, either in CO or FI. You will also need to understand the differences between business areas, functional areas, profit centers and segments, and be tasked with advising which options to implement. You might encounter customers that do not use profit centers but could benefit from their use. You should also be clear that a new GL version of profit centers is different from a classic version of profit centers. While using the classic version of profit centers is still possible, customers should be discouraged from their use. If your customer is currently using classic profit centers, you should advise. Once you understand the capabilities of profit center accounting, you will be able to advise your customers about how it fits with their business functions. Utilize SAP profit analysis tools, explain profit center accounting changes with FI and the new GL, explain uses and derivation of segments, describe relationships between FI, CO and PCA, explain profit center standard hierarchy definition, explain profit center derivation options within business processes, explain profit center transaction data, explain period and allocation for profit center accounting. So when SAP uses the term profitability analysis, both profitability analysis COPA and PCA are included. As discussed in the previous chapter, COPA covers product, market and service profitability. Profit center accounting is defined as organizational level profitability analysis. The two tools provide different information. COPA is margin reporting for product and market analysis, while profit center accounting uses account level detail including an income statement and balance sheet. So here is a tip. Profit center accounting is an optional functionality. While the data in profit center accounting is similar to FI data, no set rules define the scope of a profit center. You will need to assist your customers in defining profit centers. You may find organizations that don't use profit centers at all and other businesses that do most of their financial analysis through profit center accounting. Profit centers are a reporting dimension and a statistical assignment object. Profit centers cannot receive standalone postings. They must always have a companion of a real assignment object such as a company code or controlling cost object. Profit centers are posted in conjunction with company codes or controlling cost objects. You can, however, move postings from one profit center to another, which can be done with manual entries or period end allocations. Two versions of profit center accounting currently exist. The initial version, classic profit center accounting. So we have a warning message here. The assignment to a group occurs immediately. Any changes to the group structure occur immediately. No previews are available before changes are committed. Profit center standard hierarchy. A standard hierarchy shown in this figure shows the structure of the hierarchy including the assignment to group levels and an activation status. Many organizations make frequent changes to their hierarchies, which thus require significant effort spent maintaining the hierarchy structure. SAP S4 HANA's enhanced functionality with flexible hierarchies can generate hierarchies based on master data attributes. This capability can be used for reporting based on profit center master data attributes. With the SAP Fiori app, Manage Flexible Hierarchies, you can set up a new flexible hierarchy by defining a sequence of selected attributes. This app also provides a fast and efficient way to set up different hierarchies in parallel just by specifying different sequences of attributes. So here we have an important note. The Manage Flexible Hierarchies app supports mass changes to master data attributes as well. So profit center. The initial settings for profit center master data include an ID, an assignment to a controlling area, and validity dates. Other relevant master data fields are shown in figure 8.3. Notice the similarities between cost center master data and profit center master data. Some additional settings for profit centers include the following. So it is like status profit center must be activated to receive postings. A profit center must have valid dates and be activated. Analysis period valid dates for the current master data settings. This setting allows before and after reporting for profit center information. Name. This field contains a short text to define the profit center. Think of this name as a nickname for the profit center. Long text. This field gives you the ability to assign an extended description to the profit center. User responsible, an SAP system user ID, person responsible, an actual person's name or title, department, free assignment field for business organization, profit center group and segment. Profit center group level within the standard hierarchy, segment ID for a relevant business segment. So in this slide, we are going to see a segment is a sub area of a company. This concept was introduced in the new GL to provide a dimension for reporting to meet legal requirements for market or geographical reporting. This requirement was directed in the IFRS 8 and US GAAP for reporting beginning in 2009. These instrument requires companies to disclose business segments that are 10% or more of their business operations. A segment can be assigned to multiple profit centers. Generally, a segment is not entered manually but instead derived from the profit center. SAP provides a tool in customizing to derive segments from a prior document posting. A key indicator in the profit center is the company code column shown in this figure. The profit center to company code relationship is many to many. This indicator allows profit center postings to all selected company codes, assuming that the period is valid and that the profit center status is active and is not locked. Account. The classic version of profit center accounting had unique account numbers used for postings. In SAP S/4HANA, Profit Center accounting uses GL account master records. The technical structure of Profit Center allows the utilization of all four GL account types. These account types were discussed in previous chapters. The effect is that profit centers can post to all FI accounts as well as to all account relevant to CO, essentially seeing all postings. Statistical key figures. CO traits continue with another master data element. Profit centers can use statistical key figures, which is shown in this figure, which are the same master data elements seen in cost center accounting and serve the same purpose. Statistical key figures can be used as tracing factors and for key importance indicator reporting. Transfer pricing. Transfer pricing has become more prevalent with the expansion of multinational companies. Statutory reporting requirements are increasingly complex as companies move goods between business units and across legal boundaries. To facilitate this reporting requirement, companies employ transfer pricing. Transfer pricing is part of the material ledger functionality, which is compulsory in SAP S/4HANA. There are three technical options in material ledger: parallel valuation transfer pricing, parallel currencies, and actual costing. Parallel valuation and parallel currencies are available out of the box but require additional setup. Actual costing is an optional functionality that must be activated and configured. Transfer pricing is used to accommodate accounting requirements to value products at cost plus pricing as goods traverse across business units. Cost plus pricing markup is defined by the applicable accounting principles. This has become more significant as organizations become more multinational. Parallel valuation can be maintained in three prices simultaneously as shown in figure 8.6. So legal valuation view, group valuation view, and profit center valuation view. So legal valuation view value at the company code level required for FI reporting, eliminates internal business upcharges. Group valuation view value at the group view without any intercompany upcharges. Profit center valuation view value at the profit center level to accommodate profit center accounting reporting. Let us see the example. So group view, we can see revenue, cost and profit, and in legal view we can see revenue, cost and profit and company code 2000. So it will be divided into the companies. So profit center valuation is like profits, depends on, it calculates with different profit centers and totally the profit will be the same. Even though we follow different methods, at last the profit will be same in all the methods. The steps to activate transfer pricing are extensive and go beyond the scope of the exam. For the purposes of this book, let us review the steps and associated key decisions at a high level. The first step in the process is to set up the value add logic or upcharges. Profit center accounting has a key role in transfer pricing because it maintains the upcharge between business levels. The substance of the upcharge is dependent on accounting principles or business requirements. In conjunction with the transfer price, the material ledger maintains the three values separately for inventory valuation, which are then maintained in the Universal Journal. The menu shown in figure illustrates where transfer pricing logic is defined in the IMG. Transfer prices also need to be activated using the IMG menu activities shown in figure. Transfer price activation. Multiple valuation approaches or transfer prices. Transfer prices also need to be activated using the IMG menu activities shown in the figure 8.8. At this point, you need to decide which of the three valuation views to activate. You also need to define a version in the CO area in which to store the different prices. This allows the system to maintain price details for different valuations. Finally, you need to assign a currency type to each valuation. The material ledger can maintain up to 3 parallel valuations. After activating transfer prices, you need to determine how the values will be stored in the Universal Journal. The configuration path is financial accounting, global settings, ledger, define settings for ledger and currency types. These settings shown in this figure determine how your values will post to a ledger. You have two options: parallel single valuation ledgers or multi valuation. Parallel single valuation stores the transfer price values in separate ledgers. This requires you to report the values in separate parallel ledgers. The second option, multi valuation, stores the values in. You have two options: parallel single valuation ledgers or multi valuation. Parallel single Parallel single valuation stores the transfer price values in separate ledgers. This requires you to report the values in separate parallel ledgers. The second option, multi valuation, stores the values in one ledger. However, additional currency types need to be defined in order to store the different transfer price valuations. The currency type settings shown in figure are in the same menu as ledgers. Integration with financial accounting, profit center derivation. We can see the profit center can be derived from internal orders, project, business process, fixed asset, cost center, company code, material, manual entry, document splitting, segment, default account assignment, document substitution. To begin processing postings to profit centers, understanding how the profit center is determined is critical. In most cases, profit centers are derived during the data entry process. The system will try to determine a valid profit center and fill in the profit center field in a line item. Figure 8.11 shows the master data connections used to derive a profit center. Wherever possible, the system will also derive a segment from the master data associated to the profit center. Segments and profit centers can be determined through master data assignment, a program business add-in, BADI, a substitution, or the document splitting process discussed in the next session. The processes shown in this figure will be explained in further detail throughout the integration sections of this chapter. We will begin profit center derivation through FI account assignment, means FI posting. During manual posting, several sources can impact profit center assignment. The simplest derivation is using primary cost elements. Primary cost elements require the assignment of a cost object. As shown in this figure, the cost object is entered in the document and the profit center is derived from the cost object master data. The example shown in the figure 8.13 illustrates the profit center assignment. Cost objects can be entered manually in the posting, assigned through CO automatic account assignment are determined through substitution rules. Automatic account assignment in CO was discussed in the previous chapter. So if we can see FI account assignment, here we can notice a warning message which says, note that when profit centers are derived from cost object, the system will validate the assignment from the cost object's master data, which is shown in this figure. It will issue an error if a different profit center is entered. So if a cost object is created without reference to a profit center, the profit center must be entered manually or derived by one of the following means. Document splitting. Classic profit center accounting has a limitation when receiving balance sheet postings. Most balance sheet accounts were loaded during the close process, drastically limiting the ability to see real-time profit center reports. To resolve this problem, profit center accounting uses a process called document splitting, which comes in three types. Classic profit center accounting has a limitation when receiving balance sheet postings. Most balance sheet accounts were loaded during the close process, drastically limiting the ability to see real-time profit center reports. To resolve this problem, profit center accounting uses a process called document splitting, which comes in three types: passive splitting and active splitting, zero balance splitting. Derivation through an automatic process that uses data in existing postings, which doesn't allow user intervention. An example would be clearing a payment in an automatic payment process. Active splitting. A set of rules defined in customizing the trigger derivation logic. An example would be splitting the FI company code balance sheet account to a profit center and segment level. Defined in customizing the trigger derivation logic, an example would be splitting the FI company code balance sheet account to a profit center and segment level. Zero balance splitting. This process ensures the profit center and the segment always balance to zero. When an FI document is unable to balance the posting to zero, the system uses a designated account to offset the difference and thus zero balance the posting. The system automatically generates a line item for the offsetting account. Generates a line item for the offsetting account. So as we seen here, we have passive splitting, active splitting and zero balance splitting. Passive splitting is where the information derives from the invoice, and active splitting is where the balance sheet account is uh, splitted to profit center and segment level. And zero balance splitting is when a document is unable to balance the posting to zero, then the difference amount will be posted to the zero balance account. So active splitting is the most familiar document splitting method. Since this process occurs during accounts payable invoices, in this section we will provide an overview of active document splitting. The other document splitting options are beyond scope of this book. Active splitting characteristics must to be defined to identify the fields to be populated. So in this figure it shows the settings that select characteristics to split. Three possible characteristics to be split are profit center, segment and business area. These characteristics can also be set to zero balance and mandatory. Once document splitting has been defined, you will need to activate the process, which will also identify the method to apply. Once a splitting characteristics has been defined, Parameters must be entered to facilitate the splitting process. The main components of active document splitting are item category. Categorize real accounts together. Accounts in the group will be handled with similar logic. Business transactions SAP program logic that is executed when you perform a transfer posting. Business transaction variant, an identifier to represent this combination of item category and business transactions. Validates accounts and business processes can use a splitting rule. Splitting method, all possible splitting rules for the business transaction. Splitting rule specifies which item categories will be split and used to derive account assignment. So once the splitting characteristics has been defined, parameters must be entered to facilitate the splitting process. The main components are item category, business transactions, business transaction variant, splitting method, and splitting rule. The effect of document splitting can be seen in the GL view of an FI document as shown in this figure. The initial document entry split the expense to two different cost objects. The initial profit centers were derived from the cost object master data used in the expense posting. Document splitting took the ratio for the two expense accounts and applied it to taxes payable and the vendor payable. The document is balanced to zero for the company code and the profit center. The effect of the document is real-time posting of payables. The effect of document splitting can be seen in the GL view of an FI document as shown in this figure. The initial document entries split the expense to two different cost objects. The initial profit centers were derived from the cost object master data used in the expense posting. Document splitting took the ratio for the two expense accounts and applied it to the taxes payable and the vendor payable. The document is balanced to zero for the company code and the profit center. The effect of the document is real-time posting of payables. Constant profit center and segment. In classic PCA, one profit center was designated as the dummy. The dummy would accept postings if the system could not determine a valid profit center. The effect was FI and PCA were kept in sync. At period end, a process was needed to reallocate these postings. In SAP S/4HANA, a dummy is no longer required. If the system cannot derive a profit center, then the field is left blank. In the document splitting settings shown in this figure, you can define a constant profit center if desired. Doing so will have a similar effect to having the dummy to assist in the reconciling processes. In these same settings, you can also set a constant segment which can act as a fallback if a segment cannot be derived. In the event of a profit center or segment is not desired, then entries without the field populated become reconciling items. At period end, any postings to the constant should be reassigned to valid profit centers. So in classic PCA, one profit center was designated as dummy. So in SAP S/4HANA, a dummy is no longer required. If the system cannot derive a profit center, the field is left blank. The set default account assignment. In profit center settings, you can assign specific accounts to a default profit center. This assignment is typically used to help the data entry process for non-operating or balance sheet accounts. The challenge with setting default account assignments, however, is reduced flexibility. Example, profit center assignments are shown in figure 8.17. Since these settings are at a profit center level, these settings are also a CO level setting. As a result, all postings across the controlling area will go to one profit center. So here we have a warning message which says the accounts are assigned in configuration, which is a limitation since most users that don't have access to configuration. This type of information can also be difficult to maintain as master data updates occur. An additional account assignment process is assigning a FI company code. As shown in this figure, this process is similar to the previous process but is more specific. Since accounts are assigned at the company code level, this adds the flexibility of assigning a profit center directly at the company code level. Document substitution, a flexible account assignment tool. The document substitution process is available throughout the system. Each substitution is made up of defined steps shown in figure. Each step can be considered an if-then statement. The step contains a prerequisite and a substitution. The prerequisite is a rule identifying the parameters to consider. If the requirements are met, then the substitution determines the next action. This process offers you the ability to apply more advanced logic to assign a profit center. So, asset accounting. Asset accounting is an FI process that requires additional information to link to CO. Asset master data requires the assignment of a cost center as shown in this figure. The cost center is needed to post expense or revenue postings relevant to assets. The link between cost centers and profit centers provides profit center detail plus the link between profit center and segment. So note, many times questions arise about the difference between cost centers and profit centers. Even though cost centers can receive revenue posting, they usually only have cost posting. Profit center receive all cost and revenue postings. In addition to expense and revenue postings, profit centers can receive balance sheet postings, which is not possible for cost centers. The master data assignment for segments is not adequate for asset reporting. Segment reporting must be activated as shown in figure. You simply activate the switch segment reporting active. Once the segment activated, you will need to activate the account assignment characteristics for asset accounting as shown in this figure. This activation directs the system to record the account assignment for acquisition transaction processing and depreciation processing. Other account assignments like cost center and work breakdown structure elements can be activated. These settings allow FI postings to include segment and profit center assignments. If assets have been initiated prior to activation of additional objects, you can use standard tools to derive account assignment objects. This activation directs the system to record the account assignment for APC and depreciation processing. Other account assignments like cost center and WBS elements can be activated. These settings allow FI postings to include segment and profit center assignments. If assets have been initiated prior to activation of additional objects, you can use standard tools to derive account assignment objects. Integration with materials management. So the business integration for profit center accounting is MM. The link between a material and profit center provides profit center and segment level detail for material processes including purchasing, inventory valuation, production and materials transfers. The initial profit center assignment for is the material master as shown in the figure. The profit center assignment in the material master is at the material or plant level. This scenario provides flexibility in managing materials by to further understand the implications. Remember that plants are assigned to a company code. Materials are not assigned to a company code directly but through the plant or company code assignments. One plant can have different materials assigned to different profit centers. So here we have a tip. A material in different plants could have the same profit center but different company codes. You could have all the materials in a plant all belong to the same profit center. Let us now evaluate the link between materials and profit center for specific logistic processes. Purchasing. At the line item level of a purchase order is the account assignment indicator. If the indicator is blank, then the item will be posted to the relevant stock account. The assignment for the profit center will be derived from the material master record. If the account assignment is populated in the purchase order line item as shown in this figure, the profit center will be defined by the master data of the account assignment object. Procure to pay process. Purchasing does not require a material, so we will focus on the account assignment field at the PO line item. If the item will be valued on the FI balance sheet, the field is blank and a material record is required which will derive the profit center for balance sheet posting. A purchasing line item will require an account assignment as shown earlier in the figure. The account assignment determines the purchase item is for a purpose other than inventory. The key in the account assignment field indicates the purpose. Material records are not required for account assignment items. The profit center will be derived from the account assignment object. The procure to pay process is shown in figure. The profit center accounting boxes identify when a profit center value is posted. In classic profit center accounting, these boxes represent individual profit center documents. In SAP S4 HANA, these boxes represent profit center values posted to Universal Journal. The procure to pay process is shown in this figure. The profit center accounting boxes identify when a profit center value is posted. In classic profit center accounting, these boxes represent individual profit center documents. These boxes represent profit center values posted to the production planning. Notice in the production order that assignments can have several assignments as shown in this figure. In make to stock environments, the profit center is derived from the plant material assigned to the order. In make to order environments, the profit center is derived from the MTO object such as sales order or project. Postings to the production order will follow a similar path. Labor postings to production order will credit the profit center of the sending cost center and debit the profit center on the production order. Overhead assigned to the order debit the profit center assigned to the order and credit the profit center of the sending object. This process will use the overhead account assigned in the overhead function. MTS materials issued out of stock will credit the stock account of the plant material profit center and debit the consumption account of the order profit center. MTO stock issues will credit the stock account of the material profit center and debit the consumption account of the order profit center. Goods receipt from the order to stock will credit the production output account of the order profit center and debit the stock account of the plant material profit center. Integration with sales and distribution. All postings to sales and distribution require the assignment of a material. However, the sales item does not automatically accept the material to profit center assignment. The system provides a derivation process to select a profit center for SD, which gives your business the flexibility to manage revenue and cost of goods sold by different profit centers. A sales order will first check for a substitution rule. A few settings in a substitution rule that can initiate a profit center are business area, customer, distribution channel, material group, order region, sales district, sales group. If the prerequisite in the substitution rule is not met, then the profit center of the line item material will be used. The profit center assignment shown in the figure can be found in the item level detail under the account assignment tab. Now we have come to the order to cash process. Goods issued to sales order will credit the profit center of the plant material and debit the cost of goods sold account of the sales order line item profit center. The cost of goods sold account will also debit the profit center in COPA. Billing the order will debit revenue on the order profit center and the customer's accounts receivable account. The revenue will also be posted to the profit center in COPA. So in this figure, it shows the order to cash process. Similar to the P2P processes, the boxes represent when the individual line of business receive postings. The easiest way to understand when a profit center receives value is to keep in mind that FI and CO postings will trigger profit center postings. So this table shows how a profit center is derived from various business processes. So posting detail, cost elements, profit center derivation is CO, object master data profit center, automatic account assignment, CO, allocations, credit sending object, profit center or debit receiving object, profit center, CO, labor allocation, credit sending cost center, profit center or debit production order, profit center, non-operating or balance sheet account, constant document splitting, substitution, profit center accounting, account assignment, FI default account assignment. So these are all the places where the profit center can be derived. And for assets, asset master data, goods receipt, stock material, goods receipt, non-stock material transfer, MTS production, MTO production, goods issue, stock, sales order, post goods issue, billing, profit center allocations. So profit center derivation can be done based on the specified fields. Period and close. In this section, we will see that the steps for profit center closing are similar to other CO functions. The challenge for period and close is coordination among all CO and FI functions. One common process for profit center accounting is reconciliation between FI, CO and PCA. No standard process exists for period and closing in CO. The process will be unique to each business depending on the desired data flow and the SAP functions that have been activated. For example, One business may choose to perform cost center allocations, then order settlement, then profit center allocations. Conversely, another business may perform order settlement and then cost center allocations, but no profit center allocations at all. As demonstrated in business processes, the derivation of a profit center is most likely to happen through master data assignment. SAP has a tool to review the assignment of profit centers and objects. The assignment monitor shown in figure will show you profit center assignments to objects and objects without profit center assignments. So here is a tip: this process should be executed periodically to verify profit center assignments are correct, or if profit center postings are found to be inaccurate. After SAP ERP enhancement pack, changing profit center assignments require a project be created. The requirement was set up to protect against master data inconsistencies. The same process was implemented for segments in SAP ERP EHP 5. You have the option of using cost center allocations at period end, which includes the profit center. You can also perform allocations directly in profit centers. In SAP S4 HANA, you can use assessments and distributions for profit centers, segments, and functional areas. Here we have a note which says distributions in profit centers also allow you to allocate between balance sheet accounts as well as profit and loss accounts. These allocations are built on structure of allocations in cost center accounting and use the cycle segment method. Using profit centers as an example, you can allocate primary cost elements with a distribution and allocate secondary cost elements with an assessment as shown in this figure. A distribution allocation works in a similar fashion to a cost center distribution. It retains the original primary cost element from the sender. The difference is the secondary cost elements are statistical posting, so only sending and receiving objects are profit centers. So a cycle can contain multiple steps. Each step in the cycle has one allocation rule which are executed in sequence. These steps are called segments. Segment contain the following information. So we can see here the cycle type is assessment, actual, use of object to be found. So segments contain the following information: the tracing factor, fixed amount, percentages, portion, senders, receivers, tracing factor values. So tracing with the allocations rule how the values will be transferred from the sender to the receiver. Values can be entered in the following ways: fixed amount, manually enter values per receiver. Percentages, percentage value entered by receiver. Portions, statistical key figure values. The system totals all the key figures and calculates a proportion. Statistical key figures used in profit center allocation are the same master data values used in cost centers. It is still necessary to enter profit center level quantities. The values can also be derived from the logistics information system quantities. In the allocation, you will also need to identify the appropriate ledger where the data resides. In senders, objects that contain the value being sent. Receivers, objects that receive the allocated amounts. Tracing factor values. For each tracing factor, the value applied to each receiver. The final step in closing is to review profit centers for manual postings. If postings have occurred in the constant profit center, you should evaluate these postings. You can move values from one profit center to another in PCA. You cannot, however, change the prima nota, that means original business process that initiated a posting. If the error indicates an issue with the initial posting, then a correction needs to be initiated in the prima nota. Okay, this is what about period and close in profit center accounting. With this, slide we have completed the profit center accounting in detail. So in my next video, let me cover the question and answers for profit center accounting. Then I am planning to do videos on SAP practice, where I am going. So we are going to continue the series of controlling, where I am going to practice in SAP system all these configurations. And so stay tuned to watching the CO videos, and thank you so much for watching.